Have you ever wondered what would happen to your loved ones if you were suddenly no longer around to provide for them? It's a sobering thought, isn't it? This is where the magic of life insurance comes into play. It's more than just a piece of paper or a monthly premium. It's a financial safety net that keeps your family secure when life takes an unexpected turn. Let's start by understanding what life insurance truly is. At its core, life insurance is a contract between an individual and an insurance company. The individual pays premiums, and in return, the insurance company promises to pay a certain sum of money to the individual's beneficiaries upon their death. This payout, often referred to as a death benefit, can be a financial lifeline for your loved ones when you're no longer there to support them. It can help cover funeral costs, pay off outstanding debts, or even provide a nest egg for your family's future. But just like snowflakes, no two life insurance policies are the same. There are different types of policies to suit different needs and circumstances. Term life insurance, for instance, covers you for a specific period of time and pays out only if you die during that term. On the other hand, permanent life insurance provides lifelong coverage and has a cash value component that grows over time. Whole life insurance, a type of permanent insurance, guarantees a death benefit and has a cash value portion that grows at a guaranteed rate. Universal life insurance, another type of permanent coverage, also offers a death benefit and a cash value component, but allows more flexibility in premium payments and death benefits. There's also variable life insurance, which combines death protection with a savings account that you can invest in stocks, bonds, and mutual funds. The value of your policy may grow more quickly, but it also involves more risk. Choosing the right policy depends on your personal circumstances, financial goals, and risk tolerance. But regardless of the type you choose, the primary purpose of life insurance remains the same: to provide financial security and peace of mind to your loved ones when they need it the most. So life insurance is not just a policy, but a promise of protection for your loved ones. Accidents and illnesses can strike without warning. Are you prepared? Let's dive into the world of accident and sickness insurance, an often misunderstood yet incredibly important aspect of financial planning. This type of insurance plays a crucial role in providing coverage for medical expenses and income replacement. It forms a safety net, ensuring that unexpected health issues don't turn into financial catastrophes. Accident and sickness insurance, at its core, is designed to provide financial protection against the unforeseen. Should an accident occur or illness strike, this insurance helps cover the costs of medical treatment. But it's not just about the immediate medical bills. It also provides a buffer for income loss during recovery periods, helping maintain financial stability when you might not be able to work. Now, there are different types of accident and sickness insurance policies available, each catering to specific needs and circumstances. Let's take a closer look. First, we have short-term disability insurance. This is usually utilized when you're temporarily unable to work due to an illness or injury. It provides a portion of your income for a specified period, typically from a few weeks to a year. Next, we have long-term disability insurance. Just like the short-term variant, this policy provides income replacement. However, it kicks in after a longer waiting period and can last for several years or even until retirement in some cases. This is particularly valuable when dealing with chronic illnesses or severe injuries. Then we have critical illness insurance. This policy pays out a lump sum if you're diagnosed with a specific illness covered by the policy, such as cancer, stroke, or heart disease. This money can be used as you see fit, be it for medical treatment, home care, or even a much-needed vacation. Finally, we have accident insurance. This policy provides a payout in the event of an accident resulting in specific injuries or death. It's a useful supplement to life and health insurance policies. Remember, each policy has its own terms and conditions, so it's essential to read and understand them before making a decision. Accident and sickness insurance ensures that unexpected health issues don't become financial burdens. So are you prepared? What if you could combine the growth potential of mutual funds with the security of insurance coverage? Well, that's where segregated funds come into play, acting as a hybrid of sorts, combining the best of both worlds. Let's start by explaining what segregated funds are. Simply put, They are an investment option where the money you invest is pooled together with other investors' money. This pool is then used to buy a diversified portfolio of securities, much like mutual funds. But here's the kicker. Segregated funds are actually a type of insurance contract. This means they come with some unique features that mutual funds just can't offer. The first of these features is maturity guarantees. This means that even if the market takes a nosedive, you're guaranteed to get a certain percentage of your original investment back when the contract matures. For many people, this is a game changer, providing a safety net that mutual funds lack. Next, there's the death benefit guarantee. In the unfortunate event of your passing before the contract matures, your beneficiaries will receive a guaranteed minimum amount. This can be a comforting thought, knowing that your loved ones are financially protected. Another difference lies in the creditor protection offered by segregated funds. If you find yourself in financial hot water, creditors may be unable to seize your segregated fund investments. This feature can provide a layer of financial security in uncertain times. But what about the fees, you may wonder? Well, it's true, segregated funds often come with higher management fees than mutual funds. This is because you're paying not just for investment management, but also for the insurance features and guarantees. And finally, let's touch on estate planning. With segregated funds, the money can be transferred directly to your beneficiaries, bypassing the often long and costly probate process. This can make things a whole lot easier for your loved ones in a time of grief. So, to sum it all up, segregated funds offer a unique blend of investment growth and insurance protection. They provide an interesting option for those who value the potential for growth, but also want the security of knowing their investment is protected. In the world of insurance, how significant is the role of ethics? Ethics, as in any profession, plays a vital role in insurance. It's the guiding compass that steers insurance professionals towards conducting themselves with integrity, honesty, and fairness. But it's more than just about personal conduct. It's about shaping the entire landscape of insurance and fostering trust in an industry that's often met with skepticism. Let's take a moment to delve into what ethics in insurance entails. At the heart of it is professional conduct. This means insurance professionals must adhere to a high standard of behavior. They must offer their expertise without bias, always prioritizing the needs of policyholders above personal gain. Transparency is another pillar of ethics in insurance. It's about being open and honest in all dealings. It's about making sure that policyholders understand the terms and conditions of their policies and are aware of any potential risks or benefits. This transparency builds trust, and trust is the bedrock of any successful insurance relationship. Responsibility towards policyholders is also a crucial aspect of ethics in insurance. Insurance professionals have a duty to serve their policyholders faithfully. This means honoring all commitments, providing prompt and efficient service, and treating every policyholder with respect and dignity. But ethics in insurance goes beyond the letter of the law. It's about a commitment to fairness, even when no one is watching. It's about doing the right thing, even when it's not the easy thing. It's about recognizing that insurance is not just a business, but a service that has real and profound effects on people's lives. It's important to remember that unethical behavior in insurance can have serious consequences. It can lead to loss of trust, damage to reputation, and in some cases, legal repercussions. That's why it's essential for every insurance professional to uphold the highest standards of ethical conduct. Ethics in insurance is not just about doing what's legal, but doing what's right. It's about fostering a culture of integrity and respect, and ensuring that the insurance industry serves as a beacon of trust and reliability. Because in the end, insurance is not just about policies and premiums, it's about people, and people deserve nothing less than the highest standards of ethical conduct. How does the common law impact your insurance policies? Now, that's a question to ponder. Let's delve into it. Common law, a fundamental pillar of our legal system, plays a significant role in shaping insurance policies. It's a system of law based on precedent, meaning past judicial decisions. These decisions are used to guide future judgments, and thereby have a direct influence on the interpretation and application of insurance policies. One of the key principles of common law that impacts insurance is the principle of utmost good faith. This principle implies that both parties, the insurer and the insured, should act in good faith. In simpler terms, it means being honest and transparent. For instance, as a policyholder, you're expected to disclose all relevant information, including your health history or risky hobbies, at the time of buying a policy. Similarly, the insurer is obligated to clearly explain the terms and conditions of the policy. Breaching this principle could lead to a policy being voided or a claim being denied. Another important aspect of common law and insurance is the concept of insurable interest. This means that you must stand to suffer a financial loss if the insured event occurs. You can't insure your neighbor's car because, quite frankly, if it gets damaged, you won't bear the financial burden. This principle prevents insurance from being used as a tool for unjust gain. Common law also influences how insurance claims are settled. For instance, the principle of indemnity ensures that you are restored to the financial position you were in before the loss occurred, but no better. So, if your 10-year-old car is totaled, the insurer is obliged to compensate you for the current market value of a 10-year-old car, not a brand new one. Understanding common law can help you navigate your insurance policies more effectively. It's not just about paying premiums and filing claims. It's also about understanding the legal framework that governs these policies. So, equip yourself with knowledge, because when it comes to insurance, knowledge is indeed power. Let's recap the important points we've covered today. We kicked things off with the vital role of life insurance. It's not just about financial protection, it's about securing peace of mind for you and your loved ones. Next, we unpacked accident and sickness insurance. It's a safety net that can provide financial support when you need it the most, helping you focus on recovery without stressing about bills. We then dove into segregated funds, an investment option that combines growth potential and security. These funds offer unique features like maturity and death benefit guarantees, potential creditor protection, and the ability to bypass probate. We also touched on ethics in insurance, emphasizing the importance of honesty, integrity, and transparency in all dealings. Lastly, we explored common law's impact on insurance, highlighting how it shapes policy interpretations and dispute resolutions. Remember, understanding these concepts can help you make informed decisions about your insurance needs.